Web3 nomads. Everywhere jobs for anywhere people.
Right, we're live for the first episode of Exit Liquidity.
Yes, here we are.
So basically what you're going to see maybe once a week, maybe once every 2 weeks, depending on how busy we are. Me and Ben are going to try our best. We're both really kind of like to go off on our own little tangents, but we're going to try and stick to a specific topic, try and get into kind of the nuts and bolts of actually what's going on, and be a little bit more in depth than me, Jerry, and Dan just talking a lot of rubbish for like 2 hours on stream. So that's the idea. So it'll be the kind of
That's a
second
good
show.
time too.
Yeah. So it'll be the second show under what we'd like to see Blockmates roll out as like a creator network. If there are any people listening that have kind of ideas and want to pick up and run with it, obviously just come speak to us. Hopefully it gets to the point where people don't have to listen to me talk all the time. So that would be great for everyone. So if you do have ideas, then come speak to us as well. But
yeah, hit us up in the Discord. Hit us up in the Discord. Hit us up on Twitter. All places that we live.
But yeah, Ben, first of all, how are you doing?
I'm doing good, sir. I'm doing good. I'm slowly getting my new little studio here all set up. So, you know, it's getting close to amateur podcaster status.
The guitars out the back, just like shredding markets and also shredding a couple of.
That's right. That's right. Maybe I'll write our theme song.
We should get suggestions of people to submit, or we'll just get AI to do it anyway, because that seems like that's on the topic of everyone's conversation. But we're gonna get into some treasuries talk. Ben's gonna fill me in on what's happening. I'm gonna act like the idiot in the room, and then we'll just get into treasuries today. And then every time we're on, we'll record as I say, we'll try to stick to a topic of conversation. But as I say, we do like to kind of veer off on our own little tangents. So yeah. Treasuries, Ben. I know there's two big things happening.
That's right. So this week, as far as I'm concerned, there are two major developments that are going to be moving markets this week. The first one is the Bank of Japan meets in like 13 hours or something, and so that's happening very soon. And so the bond market for everything Japan is moving around like crazy, and I'm sure actually the DXY is going to be moving as a result of all the things that happen with that this week. So depending on what the Bank of Japan decides, and it could be very, very impactful to everybody, even outside of Japan. So let me give a brief overview of like what's going on there. So Japan has been super duper involved in their treasury treasury market, and so they have had to basically backstop the price of their bonds, and they have been willing to do that with like huge amounts of money, just throwing more and more money at it, basically saying, we're not going to let the price go above this. It's called yield curve control. And basically, they don't let the yield go above a certain level. And this week, the yields have been blowing out, and the Bank of Japan has been having to defend the places where they they said they would have to defend, because it got bad enough. So they were holding it at a quarter point. That's all. I mean, for a while they were negative, but like they've been holding it at a quarter point. And then recently they were like, okay, we're going to move it up to half a point. And then that move basically told everyone in the market, all right, we're raising interest rates now, because they started seeing like inflation and stuff for the first time in a very, very long time. And they don't want to lose control of their currency. And so they want to reel that in. So they have no choice but to get to get those interest rates up. And so I think there's a really good chance that, they could do something as drastic as go up a whole percentage point. Like they could go 100 bips, just because like what ends up happening if you try to do this slow moving up, it ends up the same way as kind of like the RRP, or like where basically, and this is relevant to the name of the show, everybody starts using the Bank of Japan as exit liquidity. They go, oh, you're willing to buy them at this price before you raise rates a bunch? Here, have all of them. Now you can take the depreciation. I'll wait here. Let me know when you're done. And so that's what's going on. And like if you look at the 10-year, which I've got pulled up on the screen here, like you can see that, like, let me put this on a shorter time frame. So like they were like, yeah, we're gonna keep them below 0.5%, and then boom, that's this morning. Like they're almost at 0.6 after they said they'd hold them at 0.5, which a lot of exit liquidity happening right there. So it's possible that the Bank of Japan will be like, hey, we're keeping these things exactly the same. And if that happens, then like the DXY would probably react positively. But like it's kind of difficult to tell, honestly, what the DXY would do in response to this. And the reason for that is that like the DXY is mostly the euro. Like it's mostly the euro. Like that's the biggest composition of it, right? And if Japan raises interest rates up a bunch, then what that does is it incentivizes people to bring money from elsewhere in the world. And the two biggest places where the Japanese put money are Europe and America. Like actually not in that order. It's actually America and Europe. And so like they would be repatriating money from places back to Japan. So it's possible that that would have an outsized effect on the euro relative to the dollar. And that would make the US dollar go up relative to the euro, and therefore the DXY would go up. But it's also possible that maybe they pull all their money from the US, and that affects the exchange rate the other way, because like as people are selling their dollar denominated assets and buying yen denominated assets, that's going to pull the other way. And the number 2 currency in the DXY is the yen. So, and it'll also be interesting tangentially to see how that impacts China as well, because that's going to put pressure on China if people start repatriating their Japanese money from China. And there's other like South Korea, other places, economies in that area of the world, that your area of the world to be specific, that a lot of the Japanese have kept their money in, because nobody wants to keep it in Japan when interest rates are at a quarter point, so.
And they kind of had one of the kind of longest kind of COVID restrictions, and I know for a fact they've only just reintroduced kind of tourism back into the country, because it was something, as soon as I seen that open, I was like, shit, I've got to get myself over there, because it's been so long. So all that kind of economic stimuli that would usually occur from, and we have to be correct here. There's particularly over like the Asian part of the world. I know for a fine fact, if you look at the likes of Thailand, the GDP that is made up from kind of travel and tourism is substantial, particularly over these parts of the world. So, they kind of were very standoffish on wanting to implement anything, if I'm not mistaken, for such a long time. And then obviously this is kind of playing out now, which really interesting. I don't know how this trickles back down into crypto markets as well, which would be quite interesting to see. But crypto markets were effectively the like you've got the anti-Kramer thing. Like you take the other side of the Kramer trade. Effectively, the crypto markets were just an anti-Dixie kind of correlated market for a very long time. So whatever happens there, it's going to be important for our kind of weird and small industry.
Yeah, absolutely. So, yeah, it's going to be very interesting because, like I said about South Korea too. South Korea has very high debt levels, and so like, maybe who knows like what a move of this size, like if they did decide to go up a half a point or a whole point, like it could, just throw things for a loop all around the world. Like there could there's a lot of moving parts, so I'm not going to like prognosticate like exactly which direction things are going to go. This is more one of those times where you just kind of like don't overinvest and just watch and wait and see, how things shake out, because like things could get spicy. So that was all the first thing that you need to look out for this week. The second thing is the debt ceiling, which in the U.S. we do this stupid dance every couple of years where we have a battle over raising the debt ceiling, which is basically like the equivalent of being like, should I pay my credit card bill? I don't know. It's not really, should I spend the money? Because that's all been done. I mean, if politicians didn't spend money, they wouldn't have any power. And if they didn't have any power, that wouldn't be very fun as a politician. So they like to keep the money spending part, but they also like to have these contentious battles over the debt ceiling so that they can, horse trade and whatnot. So it's very, very silly thing that's sort of been built into our system where you can even have these battles. But every time it happens, like there's some interesting secondary effects, because the treasury's ability to get treasuries out into the world goes down, and the like broader dollar system uses those treasuries as collateral and stuff. So like especially short dated treasuries, and so like you end up with these like collateral shortages sometimes where it causes people to have to unwind, sometimes in messy ways, some of their repo. And for those that don't know, since it's a brand new show, I'll explain these things all over again. But repo is basically it works a lot like on-chain borrowing and lending, right? You have a US Treasury short dated, and you give it to somebody, they give you cash, or vice versa. You give them cash, they give you a treasury. Like depending on which side of the transaction you're on, that's how repo works. And like it's basically just collateralized lending, something that is, anybody who's done any amount of time on chain is very familiar with how that process works. Liquidation's a little different, but it's a very similar process. And so so like that whole repo, it sort of gums up the works, because you get like this scarcity of collateral where a lot of people that owe treasuries can't find them, and then people that want to buy them so that they can get them can't, and like that causes issues sometimes. Sometimes these things are, especially in the traditional finance world, are actually like rehypothecated, which means that somebody borrowed that treasury multiple times along the way. So I lend a treasury to you, you then lend it to somebody else, who lends it to somebody else, and so we all are short treasuries. and and then that whole thing has to unwind, and like so that can get really dangerous too. And like when there are these collateral shortages like that. Like people are more willing to do like deeper and deeper levels of rehypothecation to you know, like secure what they need. I can't get it in the market, so I'm just gonna borrow one from this guy Grant. He seems sketchy, but I'm gonna do it. but but that's basically how that works. And so like the debt ceiling, it seems like kind of just a nonsense political thing, but like it can have like very, very real ramifications in the dollar markets, because all that leverage in repo, if treasuries start appreciating wildly because there's a shortage of them in circulation, then you can get collateral shortages, or it could go the other way too, where everybody goes, wow, these politicians are absolute clowns, I think they're just going to default. Like if that happens, then people will just go, I'm out, I don't want anything to do with treasuries. I'm like I'm gonna short the hell out of treasuries. I'm going, like, these things are toxic. Like if that happens, then everybody's collateral goes down. And just like in crypto, where you get these like cascading liquidations where, oh, everybody's collateral's down, so now you got to liquidate the collateral. Boom, price goes down. Boom, boom, boom. I mean, that is the problem with collateralized lending, is you get these sort of like cascades of liquidity that just, becomes a self-reinforcing trend. And so that could happen too. So back to my original point of
what's the process of them kind of getting the debt ceiling extended then?
Basically, they just have to agree on a number and pass the bill to make it happen. So it's really just an opportunity for them all to grandstand over, the debt ceiling and score political points on each other. But the thing is, every time they're playing a game of chicken with the economy, and like, I mean, it's sort of, like everybody knows that they're going to eventually pass it. But then again, this particular crop of politicians is really dumb. So maybe this is the one, you never know. So like, I think, it's going to be an interesting week. And like I said, both of these big events have a way where it blows up one way or the other. So it's more just don't commit too much directionally, and let's just see how this all plays out, because it's going to be fun to watch.
You're telling me I have to unwind my in profit positions?
You don't have to do anything.
Maybe
But
we do a little hedging.
if you've gotten some profits here the last couple of weeks, might not be a bad time to take a little off the table. But yeah, so the current events off to the side now, like, one of the things that we wanted to talk about today was like the notion of moving treasuries on chain. And like traditionally, like, that's been done by way of these fiat backed stable coins. So like USDC and USDT. I mean, allegedly USDT has some, but USDC, they have treasuries and other forms of debt like on their balance sheet. And so let me pull up the thing that I pull up all the time. which is the DeFi Llama has an amazing dashboard for stablecoins. And I highly recommend everybody, keep this thing on your favorites, which I apparently did not. But this is yeah, I got it up. Let me pull it up on the old screen here. So, all right. So, and the way to do this too is I usually get rid of depegged ones, and then I filter by backing, only do fiat. Okay. So this is the number that we care about here, right? Like these are the various ones. Now, if you want to approximate this, I also have an approximation of this in my trading view, where all I do is just add up the market caps of Tether, USD, and Binance, and that'll get you most of the way there. Because as you can see, like those three are, everything else is more or less a rounding error at that point. So, but 128, and this is the change the last 7 days. So this is like the amount of off-chain value that's been pushed on chain by way of these stables, right? Because like, if you think about it, like the real value that comes from these things that we have on chain is that like there are things that you can take off chain that have value and sell them in the real world and get money to pay your rent or whatever. Buy that Lambo. So like it's, I don't know. I think it's important to think about things in those terms of like the stuff on chain it's just not just like totally just magic internet money. Like it started out that way. And so like, but like as real money moved on chain, as we put like actual value from the off chain world into the on chain world, that's what really is that rising tide that lifts all of our crypto boats. And so that's how I like to think about, liquidity in the crypto ecosystem in terms of like off-chain liquidity that exists on chain. And so as you can see, it's been like pretty much down only, although there is like a nice little like, need that thing at the end there. So maybe that's a trend, but like the 7-day change is still down on the stable. So, it's been slowly draining out of the system as interest rates have come up, and that incentivizes people to move these stable coins that are only worth $1 at best into the real world, get them. So you burn the USDC, you take your money in the real world, and then you buy treasuries with it there. That's, now you just captured a 4% yield by doing that. So like there's that push to get some of that money off chain. And so that's what's been causing that drain over the last few months, as people are arbitraging yield. Now, eventually, and this is why the whole treasury thing is happening now. So I don't know if people have seen this in the news. There's like Ondo, and there's a few other teams that I'm aware of. What was the one you've been talking to?
Stream Finance, that should be out on the Blockmates channel this week as well.
Awesome. So like there's a lot of these various protocols that are working on basically making it so that you can buy actual treasuries on chain, or at least you can get a little closer, because like it's not like you're buying a specific treasury, like, because when you buy a treasury, everybody likes to think about like 10-year bonds as like this monolith, that, oh, it's a 10-year bond, but like, when was it issued? Was it issued 9.5 years ago? When was it issued, 9 and 3 months ago? Like, the thing about treasuries is they're all kind of special in their own way. They're all a very specific issuance. Some are more liquid than others, just like your JPEGs. you know, like the
Treasuries on
the
pseudo
one.
swap next.
Well, I mean, there's something to be said for that, because like there's like, let's put this in terms of NFTs, right? Your one of 2,000 or 20,000 collection, your Tubby Cats or whatever. I always got to plug the Tubby Cats. I like the Tubbies. Anyway, is going to be far more liquid than, or not necessarily going to be, but like, it's probably, if you have that many people in the market, it's going to be more liquid than another collection that's like maybe a one of 300. Like, there's just more of them to trade. And so like, in the treasury world and in the repo world, they call that specialness. Like, that's literally what they call it.
That sounds like
and-
someone from like crypto Twitter made that phrase up. What should we call it?
dude, like,
Specialness.
people like think that like crypto like invented this degeneracy, and it's like, no. This has been, this is, these guys have 50 years of degeneracy under their belts, more than that even. So like modern finance is just as degenerate. It's just that you can't see what's happening, and so people don't write stories about it all the time, because it's all happening in a black box. And it's more like, financial like hot dog. You don't really know what goes into it. You just know that the end product is all right. It's like, but like, that hot dog is packed with degeneracy.
Yeah, and then crypto lets you see how the sausage is made.
Right, exactly. And so it's just, yeah, I mean, I think it's important to recognize that all this degeneracy you see happening on chain, none of it is new. None of it is like really like, I mean, there are some like new aspects of different things here and there, but like, in general, like, trying to make JPEGs, perpetuals, and like, stuff like that. Like, it's just like, there are all sorts of financial products out there that are super niche, that like basically amount to trying to turn something that's deeply illiquid into something that you can sell and trade like it's actual money. And that all works well and good until, those are the first things to blow up when all the money gets sucked out of the system. But like, you're just moving down that liquidity. The more liquidity that's out in the system, the more you can do stuff like that. You can pretend that your JPEGs are a liquid commodity that you can just sell at any time. And then once the liquidity washes out of the system, those sorts of products just don't work. And then they blow up, and then people stop using them. And then like, once, the systems are washed with liquidity again, you're right back to it. But like, when everything's contracting, everything moves closer and closer to the base money, which is, the basest form of money is deposits at the Federal Reserve Bank. And as you move out from there, then it's like, okay, you can have a deposit at a U.S. institution overseas that has access to the Federal Reserve Bank. Or you can just have, if you, as moving further out, you can have a deposit at a bank who has treasuries, who has a relationship with that bank that has a relationship with the Fed. So like you move further and further out the spectrum. And like crypto to me is like that third bank. Like if you look at it in the whole, like it's like that third bank where you have these entities, USDC, USDT, that they have banking relationships, USDC more than USDT because of the way they're kind of angling to be, they're sort of angling to get themselves set up to have access to the Fed. So like if they end up getting a master account at the Fed to where they could like borrow, do basically collateralized lending with the Fed and like have infinite access to reserves, you know, that would be like, they would be a US institution that is the safest form of collateral, because you can't have a bank run because the Fed will backstop it, you know, like,
Certainly
and
feels it's going that way.
it does feel like it's going that way. But right now, as it currently stands, a bunch of USDC's collateral is actually being held by BlackRock. And BlackRock is holding it into a money market fund for them. And so, you know, I'm sure that BlackRock has better access to the Fed than Circle at this point. But like, so as far as like fiat backed stables, yes, there's the whole like argument of like, whether or not something is, censorship resistant or not. And nobody's claiming that USDC is that. But as far as like meeting the needs of being a stable coin, I think that it would be difficult to argue that Tether is more likely to survive a run than USDC.
Yeah, that's interesting.
Now Tether has certainly done it.
Yeah,
they've
been through the first share. Jesus, it's every week. It's Everford. What are you saying there about the contraction has kind of played its part in why this is even, we're having a conversation about treasuries and off-chain yield coming into the fore, because as soon as liquidity was leaving the system, volumes obviously drying up, yield dries up as a consequence. Maker probably sat there with the treasury idle and thinking, well, how can we go about doing this? And then that was the first instance that I seen. Obviously, new USDC held a bit in short-term treasuries as well. But then the first real kind of catalyst for me that's kind of spurred on this whole moment was Maker did like this 500 million in taking some of their treasury off chain, buying bonds and also buying some. Can't remember what the other asset was, but that was kind of, as you were saying, as the contraction happened, liquidity leaves the system, volumes go down, trading fees, and all that kind of jazz dries up. People are left looking. They can't just be sat there idle whilst there's yield opportunities off chain. Do you know what I mean? So that was the kind of first big catalyst that really kind of piqued my interest with regards to this whole conversation.
Yeah, I mean, and that's exactly it. That's exactly it. Is that there's been this push because of that interest rate differential. Like, because in crypto, it's been this whole like real yield narrative, right? And in retrospect, like that was, hey, everybody in crypto, don't take it off chain to go put it into treasuries, put it into these protocols that are creating actual yield, because there's that push. People are feeling that need to get some yield on their thing, and there's no activity really going on to generate said yield, or very little activity going on to actually generate said yield on chain. And so people are pulling their stables off chain so that they can capture the yield rather than Circle, or because Circle is just raking it in right now because they can buy all these treasuries and get 4% returns on my stables. Like, the fuck. I get nothing. I get 4%.
You get a nice
So,
bit of USDC sat in your wallet. That's what you get. You get
yeah,
optionality.
I do have optionality. There's that. And, so that is what's created this push, right? But the push is going the other way too. And this is where on-chain treasuries come in, because right now you have $128 billion worth of stable coins sitting there earning no yield. And that's a lot of liquidity just sitting there doing nothing in the on-chain system. Like, look at the interest rates on like on things across DeFi, right? Like, here, let me pull this back up again. So, like, how many of these APYs here are below what you could get on a US Treasury? And yet some of these things have massive amounts of TVL. Like,
Yeah, if you go to stables, just below that, stable coin pools on the yield, just third from the bottom on the left.
wait,
Left.
okay. Uh,
Yeah.
there
So
you
this
go.
is
Yeah.
this is why this just highlights it perfectly.
Yes, exactly.
You're not going to take smart contract risk
Yeah, and
for
exactly.
1%.
And this is why I'm ultimately bullish on crypto, is that, like, what you see here is funding ARB. So this creates an ARB opportunity for anybody that can put treasuries on chain. Like, so actually the other component of this is what are the repo rates in the real world. And let me see if I can pull those up here real quick. So this will illustrate this perfectly here, because this is the general collateral repo rate. So it's called GC Repo, which is GC Repo honestly works a lot like Aave. At least my understanding of it is, like, I'm not an expert in fixed income, but, like, my understanding is it basically, there's a menu of collaterals that you can choose from that you can borrow against, and any of them are acceptable. They all have different rates, blah, blah, blah. But this is a chart that's available on the Fed that basically kind of like gives like what the general collateral repo rates are doing. And you'll notice that these are at like 4.25, which that's actually quite high, considering that well, actually, no, it's not. Actually, the 1 month treasury is at 4.39. So repo is actually cheaper than the buying a US Treasury. You wouldn't get as much buying a US Treasury as you would lend it. You would get better yield on a US Treasury than you would lending in repo. So, but anyway, this allows funding in areas all throughout the global dollar system, right? Like, this is basically the rate of collateralized lending in the broader dollar system across the world. And so what's really important for this discussion is, like, what is the delta between this 4.3, 4.25, and this APY that you're getting on stable pools in the crypto world. Because if I can use this liquidity to borrow a treasury, or I mean to buy a treasury, deposit it, borrow money, and then take that money elsewhere, then that will be a cheaper way for me to get funding than going through GC Repo. If I can do the same stuff as I could in Repo, but do it on chain and then move it back out of the system is probably ultimately what they want to do. So that's the not so bullish part, is that ultimately I think, I mean, they would leave little tidbits behind in the form of this percentage, but what would ultimately happen though is you would start seeing real yield, like actual yield, as people arbitrage all this liquidity and the funding available using it, and then funnel that back into the real world. And I think the more of these connections that get created through, like, from these bridges from the real world into crypto and back and forth, the more of these bridges that get created, the more real yield you're going to see on chain. Because right now, yes, everybody points to the fact that it's like, look, nothing real ever happens on chain. It's all people just trading Ponzi's with each other. And to some extent, they're right, because there's like not a lot. Like after, and it that was a lot more controversial thing to say, like, you know, a year ago, but or 2 years ago, because everybody would have been down your throat for saying that. But now that everything's washed out and all the Ponzi's have imploded, it's a lot easier to see with clear eyes that there really wasn't a lot of like economically necessary activity going on here. It was just, and that's not to say that crypto isn't important or good. I mean, I think it's awesome, and I think it's definitely the future. But I think that the what's happening is not necessarily like it's speculation on what crypto can be, is what we've had up until this point. But like I said, as we build these bridges, and there is a push to do so because there is an ARB opportunity, and like that is how the Eurodollar system got created in the first place. Is it was very hard for people to borrow money from, U.S. banks, and there was like this need for dollars in a system where, it wasn't always easy to get them. So people like filled this void by creating banks that would just create dollar denominated debts, and then they would so like the way the Eurodollar system basically started to flourish was you had oil money. So somebody buys oil overseas, or actually somebody tries to sell oil overseas. So like Saudi Arabia, say they go to sell oil to like a French bank or something like, or a friend, somebody in France, right? So now they got to pay for that with dollars, because that's the most like liquid currency at the time. And so in order to so what ends up happening is that Saudi Arabian entity that's selling this oil, they now have a dollar denominated deposit, and they need to put it somewhere, right? Because they just sold like $1 million worth of oil, and now they have $1 million, but they need to put it into a bank, right? And so now there's a bank that has $1 million, and they go, what the hell do I do with this? And because like banks need to have a balance between their deposits and their liabilities, or to them, a deposit is a liability, right? And so they need a dollar denominated asset to take the other side of that, so that they aren't taking on risk, right? And so what they started doing is making dollar denominated loans to whoever would take them. And that meant like basically just creating dollars out of thin air and making a loan in dollars that had nothing to do with the United States government, right? Like at no point was the United States government involved with that transaction. And so that was how the Eurodollar system basically, grew and grew and grew and grew, is like you had all this dollar denominated activity taking place, but the, the, the activity necessitated dollars. And so people would just make them. And like crypto basically is working exactly the same way. And so it's got this push that system had as well, where it's filling a need. It is money that you can kind of create permissionlessly. It doesn't really require any involvement with the government. You can just make this stuff. And then as the amount of on-chain activity scales, and as more money is like being transacted and real financial activity is taking place, the more, you're going to see that push from the real world into the crypto world. Because like right now there's this massive ARB opportunity where you can get 4% in this world and 1% over here. But it's also, that's if you're borrowing money, it's the other way around, right? So like from the perspective of an investor, right, you want to get 4%, but from the perspective of a borrower, you want to pay 1%, not 4. And so the key macro turning point here is going to be, when do people want to start borrowing? Because once the demand to borrow money starts taking hold in the real world, that is when you're going to see that push on chain for people to capture that arbitrage opportunity. But until people want to borrow, it's just a liquidity drain as people are pulling their money out to get to safe assets. But once everybody goes risk on and wants to borrow money, boom, crypto is going to blow up again.
Yeah. So there are a few kind of actionable bits of research that we should probably push people towards. And we mentioned the Ondo that's coming out of the Flux camp. I'm just going to weigh in with some comments on that. It looks like a great product. There seems to be some really strong backers, but there has been a lot of controversy with regards to token distribution and things like that. So
I saw those.
Yeah. So even if you wanted to start looking at these kind of products that are coming on chain, then yes, on the surface, the products might be great, but does that mean it's a worthwhile investment? You're probably going to see a lot of headlines.
Yeah, and like the products as I have seen them designed, and this sort of circles back to something I was saying earlier, but like with the specialness, right? And the products that I've seen that are coming on chain, it's more like somebody tokenizing a money market fund, basically, is what's happening. It's like, because a money market fund is basically like, it's a fund that has a lot of treasuries and a lot of cash. And so basically what's happened is people are basically tokenizing a money market fund, which is a little different than tokenizing an actual treasury. You know what I mean? Because like if I tokenize a treasury, like it has a specific duration, it has a specific interest rate, and it has that specialness, right? Like where it's got a very defined yield, whereas like the products I've seen, they're not really on-chain treasuries so much as on-chain money market funds. Because like what would be cool about an actual on-chain treasury is like an actual on-chain treasury has like what's called a CUSIP number, or I don't know if I've only ever seen that word read. So I have no idea how people in the business pronounce that. The CUSIP numbers, and like it is a very specific product. It's like an NFT, and like at the end of the duration, like it to make like a true on-chain treasury, to me, you would need to have that sort of like one of one quality or one of like 100 quality, where they've issued like 100 of this particular tenor of bond on this particular date. And it would be like, okay, this is a treasury that exists in the world, and it's not just like an approximation of that by way of like, because like a money market fund, you're just buying a fund that buys treasuries, so it's really not that different. I mean, basically the only difference is Circle takes all the money and they get all the yield for themselves. These on-chain treasury protocols in general, they basically try to share that money with you in order to gain adoption. But like I said, it's not like they're creating like they're taking specific issuances from the treasury and going, all right, this particular issuance is now on chain as an NFT, and if at the end of 6 months, this 6-month bond will be worth this amount.
Mm-hmm.
For
that's
2% more than what you put in.
That's what I found interesting about how you'll have to give it a listen this week, but how the Stream Finance guys were explaining it. They didn't want to get into, so like imagine this as a user flow. So you come over, there's a specific vault, a specific epoch date, and I think it'd be effectively a 4626 vault. He did want me to cut out the part of what happens after that, because Ondo have just delayed their release. So they're going to push theirs back just another week, because they feel like they're going to get some kind of collusion on how they actually go around it, after they had a bit of a head-to-head on Twitter around both of the mechanisms for obtaining this yield. So then effectively it would be kind of semi-liquid, and then that's, as I say, you'd be getting exposure to it, but it would be a purchase, which is quite interesting. But as I say, I want to put you in touch with them, because I think we could even have them on here in a couple of weeks and try and go for it once they're live, so we can actually see the full mechanism. But they're trying to keep it as close to their chest as possible, because they think they're going to get plagiarized. It's a really cool method.
Yeah, there's another protocol that I've been talking to that I won't name here, but like are being similarly cagey about like kind of like the flow of how this works. But like in general though, I mean, like it seems to be as I described, where it's like you've got basically a money market fund that you're putting shares of it on chain and then sharing that yield with people. So like right now, and that's why they're doing that now, because it's basically right now the demand is for people to find actual yield on chain, right? I think maybe we'll start seeing products more like I described, where it's like an NFT of a treasury. Like now would be the time to start building something like that, because like I said, once the demand to borrow money comes back, that's when you're going to see that, that tooling be super in demand because people will want to close that arb between dollar funding in the crypto world and dollar funding outside the crypto world.
That would be cool, like a marketplace for kind of treasury swaps that's facilitated by NFTs. Or my other kind of thought process would be if you could actually, I don't know if it'd work in a rebase kind of fashion or a compounding fashion if it was NFT based, but maybe those get deposited into tapioca and you borrow against.
Well, I think that like if like to be honest, like I don't know why the primary dealers don't just do that. Like so the primary dealers, for those that don't know, are the ones that buy and sell treasuries. They're the ones that deal treasuries to the world from the Fed, like the treasury. The treasury doesn't sell them directly to investors. You kind of go through a primary dealer when you buy them, is my understanding. And so and like seems like they would be the ones that would be in the best position to just take a certain portion of the treasuries they buy, tokenize them as an NFT, and then put them on chain. And then when you want, once they are, like once the duration is up, right? So if you bought a 3-month treasury, 3 months later, you take your NFT, you burn it, they give you their dollar, on-chain dollars, whatever their choice of on-chain dollars might be, USDC maybe, who knows. But they would take that and then they would give it to you, and you would make an extra 2% or whatever or 1% during that time. And then, then you can work on like making those assets more liquid by, creating tooling to like, swap those things or like, but like there's like a whole swath of tooling that's going to be needed here. Like when I look across the crypto landscape, like our tooling is still very nascent as far as like when you when you compare it to what is in the traditional financial system. Like we don't have the tools for all this stuff, and we don't necessarily have legal ways of getting things on chain. And that's the part that I think has actually been part of the government's strategy to kind of limit the damage of all this stuff while that stuff gets built, and in some cases just built by their buddies. But I think that's ultimately what is needed here, is that like there's like a whole path. Like I've said this before, but like we're like speed running the history of finance on chain, and like it still takes time to build this stuff, right? And so like we're working our way through it. But like once you start being able to trade treasuries online, now it becomes necessary to be able to speculate on interest rates online. And then once you can speculate on interest rates online, like you start getting like, oh, now we need credit default swaps. Now we need like all of these various like pieces of tooling that exist in the traditional financial world that don't exist on chain. And so
did I send you Vault's protocol the other day? Is it you I sent it to?
I don't think so.
So interest rate swaps on chain.
and
which is like a $250 billion a year industry or something.
I mean,
like I don't say quadrillion as like to be like hyperbole or anything. That's like literally the type of notional volumes that are traded.
It is notional volumes. That I think that's the key. Like because like in the traditional financial world, you hear about like there's all these quadrillions worth of derivatives that exist. But the thing is, the majority of them are offsetting, right? Because that's how big boys that's how big boys manage risk. Is when they take a position over here, they take the opposite position over here with these derivatives, and then if there's even a little bit of delta, if there's a little bit of spread, that's free money for them. And that's how the whole world stays in balance. It's about the net exposure, not the notional exposure. So don't fall for all those fear mongering sort of things. Now, where those notional values can become relevant though is if, for example, you have $1 trillion hedged here with this guy and another trillion hedged with this guy, and then this guy does something stupid and blows up. So if you have one side of the trade had with one guy and then one side with another guy, that's counterparty risk, and that can be a bad situation. And that's where we basically ended up in 2008 was AIG. Well, AIG was basically the counterparty for everybody, and they weren't really all that careful. And then they blew up. And so, yeah.
So is there any kind of concluding remarks? So we've got the two issues happening in the markets this week that we need to be kind of aware of. We got PPI this week as well.
I haven't really been paying attention to the PPI numbers. Are interesting to me, but I don't really. They're useful from all those things like the CPI and the PPI. CPI is more useful than PPI, but those are just kind of leading indicators of what inflation's doing, and I think it'll be interesting to see where that stuff goes as well, because that's going to inform how the Fed's going to behave going forward, which I think I've said this before, but I think people are really kind of I think they're overestimating the likelihood that the Fed just completely reverses course and goes back to free money. Everybody wants the free money. I get it. Free money's cool if you have assets, and it blows up these giant asset bubbles that everybody loves playing in. But I don't think that the Fed sees monkey pictures trading at the prices of a house as a good thing from an economic perspective. I think that they're also sort of seeing in the Bank of Japan, they're seeing the ghost of Christmas future, because Japan's been doing QE since the turn of the century or the turn of the millennium. They have been doing QE. They invented QE basically. And I think that the Fed has kind of realized that this is a tool that they have, but maybe it's not a great one to be using. And at least to the degree that we've been using it. And I think now everybody sees QE as being inflationary, even though it's really not the QE that was inflationary. Because we did QE in 2008. Granted, it was to a much lesser degree, and there was no inflation for 10 years. And so, but I think the political will to do something like QE has largely been hacked a bit by the inflation bout that we've been going through. So I think that the Fed, they want to get rates high that way they can use their old-fashioned tool of lowering interest rates and controlling reserves by that mechanism. Because the whole reason they were doing QE is to functionally lower rates below zero without lowering them below zero. Because when you put them below zero, you create all these weird incentives. And it's not that you get out of it's not really like a get out of jail free card, because what you do is you create asset bubbles and other stuff instead. But like when you make interest rates below zero, then it's like, okay, now people are basically being punished for keeping their money in banks. So people take their money out of banks and they put it somewhere else. Where do they put it? Who knows? Like that sort of
Hopefully
thing.
buy some of my shitcoins.
Yeah, exactly. And I think that there is definitely something to be said for that. Like, as you go, well, if my bank is going to pay me zero or less than zero to keep it there, I'll keep it somewhere else where I can try to find a yield somewhere else. Like it props up, these asset bubbles. So yeah.
So it's going to be a big week, and
big week.
I think in the name of Barry Silbert, it's going to be a big week. I think we'll try and do these kind of as frequent as you can. I know we're opposite sides of the world, but
yeah, that's always the tricky part, being on complete opposite ends of the world. But
yeah, if there are any kind of niches in the industry or kind of topics that people want to see, I suppose they can just drop them below or jump in Discord or messages. There are 1,000,001 things we want to cover. We want to get into kind of stablecoins, treasury management from a kind of DAO protocol perspective. Maybe touch on LSDs and things as well, because they're quite topical at the minute. But any kind of topics like that, let us know.
I think there's a lot of cool stuff to talk about with liquid staking devices too. So
yeah, 100%. So yeah,
especially
that's
as Shanghai. I was just going to say, especially as Shanghai is coming at us, because that is going to make the LSD landscape quite interesting.
Absolutely. Well, we'll try and get that one in sooner rather than later then, because obviously it's a big upgrade. And even though the Ethereum devs are quite prone to being late, it's expected March. So probably got like 5-6 weeks to get that one out. Anything final?
Just until next time, try not to be Exit Liquidity.
Love it. Right. Thanks, everyone.